We're joined by Christyan Malek, JPMorgan, Global Head of Energy Strategy. Christyan, let's talk a little bit about how you think about pricing the China unrest into the crude market. There seems to be a huge amount of uncertainty here. How are you thinking about it?
Well, I think ultimately China's been a cause for concern for several years. Whether you had the trade war, now you had COVID, and now you have a reopening that's going to potentially be at risk. The way I think about this is as follows. As China continues to sort of move in stops and starts, while that's going to be sort of quite bearish on the short-term end of the part of the structure, what it fails to sort of recognize is ultimately supply. We're in peak year for supply crude globally. So we stick behind our super cycle oil call that oil will be well above $100 over the next few years. But ultimately, we're ebbing and flowing around these short-term supply-demand misses, particularly around China being very difficult in terms of recovery as we hadn't expected.
So, Christyan, what I find really confusing is if you take a look at global stockpiles, they're still quite depleted. If you take a look at product stockpiles, they're still really depleted. Yet the sentiment has been so bearish. And I'm wondering just literally, and this is a dumb question, why is crude so much lower?
You're not wrong to ask that question. I think ultimately there's a lot of dark inventory, probably the best way to put it, with flows from Russia, flows from Iran, sanctioned barrels, which were taken on very quickly in the start of the war. Now that demand hasn't come through, particularly in China, those volumes are boomeranging back into Europe. So the physical market's actually is struggling to find a bid. And then you have sort of overlaid onto that speculators who've bought into price caps and potentially a removal of Russian barrels that also isn't playing out because Russian barrels have actually been very resilient for the course of this year, and we expect that to continue for next year. So you have the risk premium unwinding into a sort of physical surplus, but that doesn't speak, that's almost deceptive in itself because it doesn't speak to what the fundamentals talk to, which is huge deficits up to 2-3 million barrels, as we've been arguing for the best part of 2 years, out in 24, 25, and 26. So you could look at this as more a sort of temporary or transient pullback. And I'd say one more thing. The more volatility you have at the front end, particularly with China weakness, the more it just pushes capex and supply out in the medium. So no one's spending, no one's investing in production. So ultimately, you're fanning the flame for the back end of the curve. So you should start to see a flattening, if at the very least.
Just to come back to the Russian barrels, is there now an expectation in the market that any price cap from the EU will have virtually no effect?
I think ultimately, I would say there's still some degree of pricing. I think ultimately OPEC are looking at this effect of a price cap and sanctions as they look at the calculus of whether to cut or not into next week's meeting. I would argue that most of that risk premium is now gone, Guy. I think the expectation is that Russia will stay resilient. However, what people I think what I think is not being considered is what's Russia's retaliation function. What are they going to do? Are they going to propose more cuts into the OPEC meeting in order to get the price up, in order to aggravate if the price caps actually go into law and the compliance is relatively high?
Staying on government stuff, is the Biden administration going to be buying at these levels? I mean, they said they would. 65, 72. Do you expect that to be happening? Some SPR replenishing here in the U.S. to support the price?
It would make complete sense. Oil is very cheap, both in historical context in terms of where we see it moving over the next few years. If there's a time to buy and get in front of it, it would be now, particularly as that sentiment, as you point out, Alex, is exacerbating the price. We don't have the clarity around demand going into next year. So you have a sort of superficial range, so to speak, that they should be taking advantage of. I don't think it's going to last very long. So we'll see what their actions are, but ultimately we've got to decide: are we in the early innings of a super cycle? Is this a cyclical, moving into a structural transition where you have multiple year deficits, or are we in the later part of the innings where the best is behind us? We clearly are in the former camp. We think we're just getting started, but depends on how they perceive the market, whether they see this as a real deficit or not.
If I'm an income investor short term, is there any risk to that income?
if you're looking at income in the majors, you've got 20% yields across the European majors, which I've known my career seen. And those yields underwrite one simple thing, that the back end of the curve is still robust, and the cash break-evens, the price to cover their capex and dividend, is so much below. It's actually half where the oil price is. So whether it's 80, 90, 100, these companies are spitting out cash and returning it to shareholders. So if anything, the buy case arguably is less so in the commodities future, but more in the equities, where you're taking advantage of those yields.
So to that point, though, if crude continues to get hit, do oil equities get hit percentage for percentage, or is that link going to be a bit different?
I think that link's going to be different. I think the decoupling's already started. I think the European majors are holding up, so the US. You may start to see a correction given US is really decoupled to oil prices and held up probably too well. But within the European context, given how much cheaper they are, they're trading at half the valuation of the US majors. I'd argue for an increasing decoupling within the European energy equities, particularly to low oil, and particularly as their cash break evens are so much lower. They're trading on the back end of the curve, which continues to stay supported by the lack of supply.
If we get a slightly weaker dollar from here, and the dollar's already given back some ground, Christyan, do I want to own US majors or European majors?
I think ultimately you're right about the currency, but given the valuation, typically Europe trades at around 40% discount to US. Now it's trading on almost 100%. Those two have to converge somewhere between around 60%. So if we're right around that convergence, whether the dollar strengthens or not, I personally think that convergence will happen as we see underweights in Europe buy into European energy through the correction in oil prices and the outperforming yield that will continue. I don't see why that would change. Particularly this as well. They're not spending. They're not investing. The capital discipline will continue into next year and the year after. So all that excess cash flow goes to the shareholder, and that's why the yields are so high. And then,
Or Christyan, does it go to governments? I mean, it feels like the political risk in Europe is much stronger in terms of all these windfall taxes that we're getting. And I'm wondering if the share prices are already discounting that, and if not, where's the downside?
I think if we see further windfall taxes, you're right, that will contract some of that free cash flow. But let's put it this way. If windfall taxes go up by another 10 to 20%, if they double, your free cash flow yields will go from where they are currently, around 25% down to 17, 15%. So you're still getting massive excesses of free cash flow. So windfall tax is not something that we can ignore, but I think the worst is behind us. And you're also seeing elevated cost of capital. So these companies were derated into so much baggage around windfall tax and other sorts of pressures. And so we're not arguing necessarily for a re-rating, we're just asking that cash flow, that yield to contract. So most of the worst is behind us. If we see more windfall taxes next year, we still see that kind of cash return coming. So take advantage of that discount through windfall tax. I think it's almost a buying opportunity. And the last thing I'd point out is the more you tax these companies, the more you restrain capex, the more you restrain supply in the future. We're at peak year globally for crude oil supply. So ultimately, you're just going to end up with a better quality, higher back end, which ultimately is good for the majors because they trade on the back end. So there's sort of an action equal opposite reaction to supply that doesn't get factored in as we think about equities.